1. Chapter 1 is a basic overview of corporate finance. And in this chapter, this is the outline that we're going to be following. We're going to be first discussing why we study finance. We look at the different types of firms, and then the goal and the role of a financial manager, and then the stock market and a general overview of financial institutions. So the first question is, why study finance? The study of finance can have two aspects to it for you. One aspect, you are approaching it from the perspective of your personal finance. Through the study of finance, you would be able to answer questions like, how much do you need to save? How much do you need to save for retirement, for college, for a vacation? And how do you make your money work for you? Whether you should loan a car or lease a car. You can evaluate which types of stocks or bonds may be good for you. How do you evaluate different home mortgages? All of that is covered within personal finance. If you're more career-oriented and you're learning finance for the sake of a business career, then finance should provide you answers about, should you launch a new product? If you're choosing among different suppliers, which supplier should you choose? Should a firm produce a good or outsource the good? If you are raising capital, should you issue a stock or borrow the money? Use debt? And how can you raise money for your own startup purposes? So a detailed study of finance should be able to answer those questions for you. Now, when you think about an entrepreneurship type model, most companies start their journey as sole proprietorship. Then, when they grow a little bit bigger, they bring in some partners. You can have limited liability corporations, and then you can have a full-fledged modern-day corporation. Most of our study of finance is directed towards this aspect, how to manage money. Finance cannot necessarily teach you how to make money. In fact, you don't need a college degree to make money. But what finance teaches you is a scientific basis on how you can manage that money. So let's look at the different forms of organization that we have. It is pretty straightforward. This is the organizational form. Sole proprietorship is the organizational form that we most use. The principal limitation of this form of organization is that there is no separation between the firm and the owner. And thus the firm can only have one owner. The good news is it gives you full control. The bad news is that you have liability that arises from your business. So the owner in a sole proprietorship has unlimited personal liability. And the life of the sole proprietorship, so this kind of a firm dies when the owner dies. And thus it is difficult to transfer ownership from one sole proprietorship to another. In a partnership, it's kind of like sole proprietorship, but it has more than one owner. All partners are liable for the firm's debt. Instead of having one person be liable, now you have multiple people are liable for the firm's debt. The partnership ends on the death or withdrawal of any single partner. So if one person dies or a person withdraws from the partnership, then you have to reform that partnership under a different name. So these are some of the limitations of partnerships. There are different types of partnerships you can have. You can have a general partner where they have the same rights and privileges as everybody else, as all the partners. And then you can have a limited partnership where you are only liable to certain aspects of the operation. and thus you have limited liability, but you do not have any management authority. So that's a trade-off. If you are a general partner, you have managerial control. If you are a limited partner, you do not have managerial control. Now, the most common form in which even partnerships work is through an LLC, through a limited liability corporation, where all the owners have limited liability. And this is key. So the owner is not personally liable for anything that goes wrong inside the corporation. But the most common form that we have is that the regular corporation, not just a limited liability corporation, but a regular corporation. And this regular corporation is what we describe as an artificial being. It is often described as a legal fiction, meaning it only exists on paper, but that paper delineates the power that this entity has. But the key aspect of the corporation is separation of liability from its owner. It's a different entity separate from the owner of the corporation. And the corporation has, although it is separate from the owner, it acts like a person that has an unlimited life, that lives on forever. And thus, like any person, it can enter into contracts, acquire assets, incur obligation, and most importantly, enjoy the protection of the US Constitution against the seizure of its property. So it enjoys the full property rights that would be available to any owner. And under some Supreme Court rulings, particularly Citizens United, corporations are viewed as people, thus these rights. And so, which is one controversial aspect, Citizens United granted corporations the powers of free speech that accrues to individual. So just like there is no limit to a free speech, or generally understood there is very few limits to free speech that we have, the corporation also enjoys unlimited powers of free speech. So that's a corporation. It is solely responsible for its own obligation. The owners of the corporations are not liable, that's the key part, not liable for any of the obligations that the corporation enters into, meaning that if the corporation enters into a contract and it defaults on that contract, then the corporation's assets would be fair game to fulfill the obligations of that contract, but the owner's personal wealth will not be fair game to be considered part of the settlement of the contract. And the corporation, vice versa, is not liable for any personal obligation that the owners may have. Okay. A corporation has to be legally formed. You have to file paperwork, usually to the department within a state. Each state has its own rules that must be fulfilled. It must be chartered within each state. The corporate charter specifies the initial rules that govern how the corporation is run. And it is obviously more costly than setting up a sole proprietorship because of some legal paperwork. It has no limit to the number of owners. The entire ownership stake of a corporation is divided into shares known as stock. So if the corporation starts with one owner, then that owner owns 100% of the stock. It adds another owner, then it will be dividing that 100% shares into whichever proportion they decide. It can be 50-50, can be 60-40, 70-30, whatever. And the collection of all the outstanding shares of a corporation is called the equity. So all of the shares of the corporation, when we add up their value, that gives us the equity value of the corporation. And we will see in more details exactly what we mean by those terms and how we calculate these values as we proceed through the course. The owner of the share of a stock in the corporation is called the shareholder or the stockholder or the equity holder. As shareholders, they are entitled to dividends if the corporation pays dividends. And they receive dividend payments that is proportional to the amount of stock that they own. So if they own, let's say, 10% of the number of shares outstanding in a corporation, and the corporation pays out a total of $100 in dividend, then you as a 10% owner of the corporation will receive 10% of 100, which is $10 worth of dividend. And there is no limitation to who can own its stock. So one individual can own 100% of the stock, or 100 individuals can own 100% of the stock. That means it is divided among the 100 individuals in whatever proportion they decide. Although most corporations, most business entities in the US are sole proprietorship, as you can see, few limited liability and partnerships. The next biggest one after sole proprietorship is corporations. But what is interesting, as you can see, 84% of total corporate revenue are generated by 19% of the corporations. Then the next big chunk is divided almost equally among LLCs, partnerships, and sole proprietorships. So much of what we consider the economic wealth of the nation is driven through corporate activity, corporate profits and corporate activity. Although most businesses are organized as sole proprietorships, essentially what we would call mom and pop stores. The four types of firms that we have, they have profound implication based on their tax policies, based on the tax policies that apply to that corporations. The corporation's profits are subject to taxation, separate from the owner's tax obligation. That means shareholders of a corporation, they pay taxes twice. The corporation pays taxes on its profit, and then when the remainder of what is left in the corporation is paid to the shareholders, let's say in the form of dividends, then they will have to pay a tax on that dividend income. Or if they sell the shares and they gain value by selling those shares, make profit by selling those shares, then they will have to be taxed on the portion of the profit that they have made. So let's take a quick example on how this thing works out. And the strategy that we will apply throughout the course is as follows. For every problem that you have, first objective is read the problem very carefully. And as you read, underline the relevant parts. Then we will outline a plan on how to work the problem. Then we will execute that plan, and then we will evaluate that plan. So those are the three steps: plan, execute, and evaluate. So before we plan, let's read the problem and underline the important parts of the problem. The corporation earns $5 per share before taxes. Key part. After it has paid taxes, it will distribute the rest of its earning to you as a dividend. Okay. The dividend is income to you. So the corporation makes a profit. That's its earnings. It takes those earnings and tells us its total earnings on a per share basis. That's the key. On a per share basis. So assume that this corporation has 1,000 shares outstanding. It has distributed 1,000 shares. Then if it has $5 per share, that means it is telling me that it has made $5,000 worth of profit, or $5,000 worth of earnings. So, on a per share basis. That means another way of looking at it, earnings per share is called EPS. Earnings per share is the total profit that the corporation makes divided by number of shares outstanding. Not number of shares traded, number of shares outstanding. Okay. So from the profit, the corporation has two ways in which they can utilize that profit. This earnings can be either paid out as dividends. And who gets these dividends? Shareholders get these dividends. Whatever is not paid out is retained. And we call that retained earnings. So whatever is not paid out is retained. So the dividend that you are receiving, essentially this is cash, and that cash means that you will have to pay taxes on that cash. The corporate tax rate is 40%, and your tax rate is 15%. So how much earnings remain after all taxes have been paid? So let's take that information and plan our problem. How do we plan it? Earnings before taxes is $5. That's what it says. $5 per share before taxes. That's why this is key, before taxes. So the tax rate, this is corporate tax rate, is 40%. And personal dividend tax rate is 15%. So we want to first calculate earnings after taxes. That means we have to take the before tax earning and subtract the taxes. So the taxes, how much taxes will we be paying? We will be paying 40% in taxes because that's the corporate tax rate. Also, we call that the marginal tax rate. So 40% will be paid as taxes, and the remainder of what is left will be distributed as dividends. So on a per share basis, how much will be taxed? $5 per share, 40% taxes, that means $2 in taxation, leaving us with $3. $5 minus the $2. Another way I could have calculated this $3 is to take the 5 and multiply that by 1 minus 0.4. So after-tax earnings is $5. After-tax earnings would be the earnings per share before taxes multiplied by 1 minus the tax rate. So that will give me the after-tax earnings. So I could have taken 5 times 0.6, and that would be directly $3. Once you receive this $3 as dividends, okay, because that's what is left over and thus it will be distributed, you will pay 15% on taxes. 15% of $3 is 45 cents. That means you have left over $2.55. Another way of doing this is 3 times 1 minus 0.15 directly. So 3 times 0.85 would be $2.55. So what does it tell us? As a shareholder, you keep $2.55 of the original 5. So how much has been paid in taxes? $2. That's my corporate tax. And 45 cents, that's my personal tax. So the total amount of taxes that I have paid is $2.45. On what's the base? On $5 worth of earnings. That means total, I have paid 49% in taxes. The effective tax rate is 49%. Similarly, you can work through other examples that are provided to you on your PowerPoint slides, 1.1a, 1.1b, very similar. You can work them out on your own and try to replicate the method that we have talked about. Read the problem, plan the problem, execute the problem, and then evaluate the problem. The next thing we are going to start is to look at the 4 types of firms that we have and look at the tax implication on the different types of corporations that we can create. We can create something called an S corporation, where the firm's profits and losses are not subject to corporate taxes. Instead, profits and losses are allocated directly to the shareholders based on their proportional ownership. And shareholders must then include these profits as income on their individual tax returns. Okay. Then you have a C corporation. Most corporations are C corporations, where the corporation pays taxes on its profits, and then the shareholders or the individuals must pay personal income tax on the dividends. Thus, shareholders in a C corporation, a C corp, are taxed twice. So let's take a look at problem number 1.1 and assume that you have elected it to be a subchapter S or an S corporation, and your non-dividend and your rate on non-dividend income is 30%. So your ordinary income tax rate is 30%. Let's rework the problem that we just did before. So we had earnings before taxes at 5%. The corporate tax rate is 0. Let's assume a corporate tax rate is 0. Because why it's 0? Because it's an S chapter. An S chapter or an S subchapter or an S corporation is not taxed. So this is because it is an S subchapter. Okay. So then 30% is going to be taxed at the personal rate. So that means our taxable or a tax portion is 30% of 5, which is 150, which means we are left with 350. Or another way we could have done it is 5 times 1 minus 0.3, which is 350. And that would be the after-tax earnings. Similarly, you get so the 150 that you pay in a S corporation is substantially lower than the 245 that you had paid when you were just a C corporation. As a result, you are left with 350 per share instead of 255 per share. So this is for an S and this is for a C. But here is the difference. And this is why most corporations elect to be C corporation. Because in a C corporation, you are taxed only when you receive the income as dividend. Whereas in an S corporation, you pay taxes on the income immediately, regardless of whether the corporation distributes the dividend or reinvests that dividend. So in a C corporation, owners have flexibility on when they want that dividend to be paid out and when they want to keep the dividend and reinvest that dividend. If they keep the dividend and reinvest that dividend, then that dividend is not being taxed in a C corporation. In an S corporation, even if you reinvest that dividend is going to be taxed on an S corporation. So C corporation gives the owners, shareholders, more flexibility than S corporations do. But the trade-off is that in a S corporation, you will pay less taxes, as we see over here, than you would pay in a C corporation. So it's a trade-off between higher taxation and flexibility on when you want that taxation to be applied to you. And that's the kind of trade-off that we will learn throughout finance. There are often no right answers and wrong answers in finance, but what you often have are a series of trade-offs. If you want to do this decision, then you may gain some things over here, but you have to give up some things over there, and vice versa. And through that process, you will have to arrive at what's the correct decision that applies to your context. Okay, Similar problems you can work out on your own, 1.2b and 1.2c. So here is a quick recap on the different types of corporations or different types of ownerships that we have. Sole proprietorship partnerships and limited partnerships are somewhat similar, and then we have a limited liability corporations, and the two major types of corporations that we just talked about are S corporations and C corporations. And you can see the different types of differences that they have with respect to number of owners, who has liability for the firm debt, who manages the firm, how does ownership change when the firm is dissolved, and how are the firms taxed when they make a profit. 5 different dimensions, and you have to make your choice depending upon what is good for you, with that which type of corporation you would like to be. So let's stop over here for the first part of chapter 1. We will continue with the second part in a moment.